Hey everybody, it's Larry Berman. Happy long weekend. I come to you on this end of the summer long weekend with a heavy heart. I don't hold myself out as a Calgary Flames fan at all, but I've only ever been to one Calgary Flames game, and I got the gift of this shirt many years ago from a friend, and anybody who pays attention to hockey and maybe not will know of his untimely passing last night on Thursday night, riding his bike. It reminds me of a very good friend of mine years ago whose father had literally just retired, was out for a bike ride in Florida in retirement, got hit by a drunk driver and was killed. And it was a Friday was a tough day that way when I think about it. So I thought I'd flip it around a little bit and just think about some of the other things in life that matter far more sometimes than financial markets. With that in mind, we learned a lot in the month of August about markets, and we learned almost nothing at the same time. So let's take a dive into the chart room and see what we learned. So we've got three total return charts here in the graphic at the bottom with their periodic returns at the top. And we can see on a year-to-date basis right now, which is interesting, the total return of the NASDAQ, which, up here was leading, is now no longer leading, where the broad S&P is now doing better than the NASDAQ. So that is something new in the last month or so. And the equal weight S&P 500, if we look at the last month, while it did better, still ultimately lagged. So as the markets recovered, there was still a lot, tech was still the leader at the end of the month when we see the numbers here, just by a little bit. But the market did broaden out, and the average stock did start to perform okay. So breadth of the market is improving. As always, it depends on your time frame and your lens, what you're looking at. But that was a pretty big message. So rotation, very much what we started to see in August, but the difference between the Qs and the SPY overall was negligible. And that's kind of interesting. When we look at the last 2 weeks of the month, 10 calendar days, we saw nothing but chop. And if it were not for at 350, seeing or 335, an estimate of 7 billion to buy at the month-end close in rotation, was a big surge to the market. So really, in the last 10 days, a lot of chop. Powell, data, PCE, the end of the day, really nothing done. When we look at the bond market, we get the same message in the month where, you had the panic sell off early, bonds got a big bid, sold off. Really, by the end of the month, bond yields in the long end were slightly higher than, well, not quite where they started the month because of that early month decline, but really the message there. We were looking at a research note from one of the banks this morning, and I want to bring that up because I posted it in our investment committee Teams chat. So earlier today in our fixed income subcommittee chat room on Teams, what we have at our firm here at Q Wealth, I posted this note that came out of National Bank. And they were citing a study that was done by the University of Pennsylvania. And they basically did an accounting of the promises under Trump policies and under Harris policies for the next 10 years. And they added them on to what the Congressional Budget Office is forecasting. The Congressional Budget Office forecast goes based on what they know today as policy. So if these new policies are implemented, what it would mean is the 6.2% annual deficit for the next decade becomes 7.7% under Trump, and 7% under Harris. So who's the fiscal conservative? Let's define what a conservative really means, but it would be worse that way under Trump. Nobody seems to care about the unsustainable state of public finances. It's bad here in Canada. It's way worse in the US. So this all will matter at some point for financial markets returns. The 60-40 portfolio, bonds, stocks 60, bonds 40, 70, 30, whatever that mix is, given this fiscal headwind, there's no other way to say it, bonds aren't going to deliver safety for clients, because for investors, because the fixed income side is just going to be challenged. And so beyond earning the coupon, what's inflation? And is there actually going to be term premium and a real return for investors in the bond market? And that number is going to be very, very low. On the equity side, with the very high multiple and valuations today, I would argue that we are pretty materially overvalued, probably by 4 multiple points. So what's that? About 1,000 S&P points. So we should probably see a correction at some point, no matter who wins the election. And the uncertainty around that is significant at this point, at some point within the foreseeable future. Now, maybe we started a little bit of that with the risk off earlier in the month. Who knows? Let's go back into the chart room and take a little bit of a dive on the bond market. So in the US long bond here, we can see that through the panic of equities in the first part of the month, we saw the long bond take off. And we got up to a yield that was equivalent to the best that was seen, earlier in the year. So long bonds on a year-to-date basis, I get this question on BNN all the time, Larry, should we buy the bond market? My answer continues to be, at these levels, it's a hard no. So we've really clamped down on the interest rate risk in our bond portfolios this month significantly, and I'm happy clipping a coupon at this point with very low interest rate risk. Money markets still pay a lot, but there's a lot now. We learned from the Fed this month, they're going to start cutting interest rates in September. This week, the Bank of Canada. So on the Canadian side of things, odds of another rate cut in Canada is a little bit more than certainty in terms of, do they do 50? Well, they don't do 50. Makes no sense for them to do 50, but a rate cut at every meeting for the next 6 months is what's kind of priced into the bond curve in Canada right now. In the US, we've got 8 cuts priced in, 825 basis points cuts in, priced in. So in September, the market is still giving a 30% chance that the Fed starts the process with 50. That will all correct on Friday after non-farm payroll. So if we get a strong non-farm payroll report, strong-ish, and we don't see a material tick higher in the unemployment rate, the odds are they do 25 and they start slow. We heard from a gaggle of Fed members after Powell last week, and the opinions are very universal. We are going to start, it's time to start. Inflation's come down, but we want to go slow. That is the message. Why the market's pricing in higher than a 25% chance or 25% basis point cut, I'm puzzled by. But it tells me that the bond market and the money market is smelling risk to equities, where equities, again, how we went out, if you look at the intraday, we're just whistling past the graveyard in that sense. So I don't like equity market risk here. I don't like bond market risk here. And again, one of the reasons months and months ago, we switched a lot of our investment holdings to the private equity side and the private credit side. And we've had a pretty good 3 or 4 months without virtually any volatility in our portfolios. And so I like that positioning now. If that's something that interests you, have a chat with an advisor at Q Wealth Partners. Have a great long weekend,